Good morning to all. I am S.Madhavan, Associate Professor in Commerce, SKSS Arts College, Thirupanandal. Today, we are going to see income from other sources under Income Tax Act. How the income from other sources are assessed under Income Tax Act. Let us see one by one. The income which are not assessable under the head income from salary, income from house property, income from business or profession, and income from capital gains are assessable under this head income from other sources. It is the last head in the Income Tax Act for assessing income. Generally, the following incomes are assessable under the head income from other sources. Let us see one by one. Income from subletting of house property, interest on bank deposit, interest on loans, rent from vacant land, agricultural income situated outside India, insurance commission received by insurance agents, income from undisclosed sources, remuneration received by a person from a person other than his employer. Example, examination fee received by the teacher and college professors. Then income from royalty, directors sitting fees for attending board meetings, dividend except dividend received from domestic companies, winnings from lotteries, winnings from crossword puzzles and horse race, winnings from card games and other games, winnings from gambling, etc. are assessable under the head income from other sources. Any sum received by the assessee from his employees as contribution to PF, superannuation or any other fund for the welfare of the employees. Income from interest on securities, income from letting out of machinery, plant and furniture, any sum received under Keyman insurance policy, including the sum allocated by way of bonus on such policy, then receipt of any sum of money without consideration, receipt of any immovable property without consideration, receipt of any movable property, receipt of shares of a company if the recipient is a firm or a company. According to section 145, income chargeable under the head income from other sources shall be computed in accordance with the method of accounting regularly employed by the assessee. The assessee can either choose the accrual basis or receipt basis as decided by him. Next, we can see the grossing up of income. In the following cases, the grossing up of income is necessary to find out the gross income received by the assessee. Winnings from lotteries, winnings from crossword puzzle, winnings from horse race, winnings from card games, winnings from gambling and betting. Then the tax is deducted at source at a prescribed rate out of the following incomes. The winnings from lottery, if the prize amount is exceeding rupees 10,000. Winnings from crossword puzzle, if the prize amount is exceeding rupees 10,000. Winnings from horse race, if the prize amount exceeding rupees 5,000. Winning from card games, if the prize amount exceeding rupees 10,000. The prescribed rate of TDS is 30% plus surcharge at the rate of 2 plus 2, 4%. For finding out the gross amount, the net amount should be multiplied by 100 divided by 100 minus 31.2. Then we can get the gross amount. We have to pay income tax for the gross amount and not on the net amount. Income to include transfer of money and or property under section 56 subsection 2. That means gift. If an individual or a Hindu undivided family receives on or after first day of October 2009 in any previous year from any person or persons a sum of amount or property which falls under any of the four categories mentioned below, it is chargeable to income tax under the head income from other sources. Receipts without consideration, where any sum of money or property received during the previous year without consideration by an individual or an Hindu undivided family from any person on or after 1/10/2009 are taxable under the head income from other sources. Nature of asset, particulars, taxable value. Money without consideration. The whole amount if exceeds rupees 50,000. Movable property without consideration. The fair market value if exceeds rupees 50,000. Movable property, inadequate consideration. The difference between the fair market value and the consideration if exceeds rupees 50,000. Immovable property, without consideration. The stamp duty value if exceeds rupees 50,000. Immovable property, inadequate consideration. The difference between the stamp duty value and the consideration if exceeds rupees 50,000. Meaning of property and relatives. The property means the following capital asset of the assessee, namely movable property being land or building or both, shares and securities, jewelry, drawings, paintings, sculptures, any work of art, bullion. Then next, relative means spouse of the individual, brother or sister of the individual, brother or sister of spouse of the individual, brother or sister of either a partner of the individual, any lineal ascent or descent of the individual, any lineal ascent or descent of spouse of the individual, spouse of the person referred to in class 2 to 6. Non-applicability of section 56(2) subsection 7, that is, cases in which gift of money or of property shall not be taxable. Any sum of money or property received, 1. From any relative, 2. On the occasion of marriage of the individual, 3. Under a will or by way of inheritance, 4. The income contemplation of death of the pair, 5. From any local authority, 6. From any trust or institution registered under section 12AA. Deduction of expenses from dividend income and interest on securities, section 57. The following expenses can be claimed as deduction from the dividend received from domestic company and interest on securities. Any reasonable sum paid by way of commission or remuneration to a banker or any other person for the purpose of realizing the dividend and interest. Interest on money borrowed for purchasing the shares and securities. Any other expenses not being expenditure of a capital nature, expended wholly and exclusively for the purpose of earning such dividend and interest. Next, the grossing up of interest on securities. Gross interest equal to net interest into 100 divided by 100 minus rate of TDS. Deduction of expenses from income from letting out of machinery, plant and furniture. The following deductions are available. 1. Repairs of the building, the insurance premium of the building, repairs of the machinery, plant and furniture, insurance of machinery, plant and furniture, depreciation on assets. Then any expenditure not being expenditure of capital nature expended completely for the purpose of earning such income are allowed. Deduction from family pension. The family pension means a regular monthly amount received by the legal heir of deceased employee. After the death of the employee, if there is any family pension received by the legal heir of the deceased will be deemed as the income of the legal heir and it is accessible under the head income from other sources. Regarding family pension, the following deductions are allowable. One third of such amount or rupees 15,000, whichever is less is allowable deduction. Following are the conditions for allowing the deductions from income from other sources. The expenditure should be incurred completely for the purpose of earning such income. It should not be the nature of capital expenditure. It should not be the nature of personal expenditure of the assessee. It should be incurred in the relevant previous year and not in any prior or subsequent previous years. Next, we can see about the bond washing transactions. Section 94. A bond washing transaction is defined as a transaction which consists of selling securities to a friend or relative sometimes before the due date of the interest and acquiring back the same securities after the due date is over. The practice is generally adopted by the high income group assessee to evade the tax by transferring securities to low income group assessee on the occasion of due date of payment of interest. Section 94 subsection 1 provides that where a security owner transfer the security on the occasion of the due date of the interest and reacquires them, and the interest is received by the transferee, the income from such security will be deemed as income of the transferor, and accordingly it will be included in the total income of the transferor.